Welcome, everyone. Thank you all for joining us. Good to see some familiar faces as well as some new people. I am Gershon Margolis. I'm going to basically give an introduction to us and the firm, and before that, I will say hello, welcome the people from our team, and Lee, our speaker, and then I'll give the introduction to our firm, and then we'll turn it over to Lee, who has a lot of good stuff to share with us. All right. So for starters, can't see everyone from our team's face, but for the people who I see, welcome Ken, my partner here at Imperial Advisory. Welcome Dean. Welcome Mark. Welcome Brittany. Thank you for putting this together. And welcome Lee, our featured speaker today. All right. I'm going to give a quick intro to and I think Jim is here, but I don't see his face. Quick intro to the firm. I'm Gershon Margolis. I'm the founder of Imperial Advisory. We are a team of ex-CFOs and senior financial executives, and we serve as part-time CFOs and consultants for businesses that need strategic financial leadership but don't need a full-time CFO. We also sometimes work for CFOs that have a lot on their plate and need more help, and that's a lot of fun for us as well. But anyway, when we're working with CEOs, we focus on strategy, growth planning, M&A, improving financial operations, whatever it is that they need to hand us so that they can spend less time focused on finance and more on just growing the business. When we work for CFOs, we're often working as an extended financial planning and analysis team, focusing on reporting, profitability analysis, forecasting, whatever it is that the CFOs need. And we work for companies ranging from, say, 5 to 50 million is usually where we're the part-time CFO, and from 25 to 500 million is where we work for CFOs. Anyway, our team is highly experienced. So besides for being CFOs, we also have experience as executives working in businesses and solving all sorts of problems. But we know where clients lean on us for advice in a variety of topics. But we know where our expertise stops and where we need to bring other people in. And that's why we've got Lee here today. Lee is the managing partner of Schwartz, a law firm here on Long Island. And besides for dealing with all sorts of corporate legal type issues, he's been spending a lot of time recently providing education on the new Corporate Transparency Act and the Freelancers Isn't or Aren't Free Act. And these are two laws. One is New York State focused, one is across the country, and these are both laws affecting many businesses in our space. And we're very happy to have Lee here to educate us on that. So without further ado, go ahead, Lee.
Thank you. Thank you so much for giving me the opportunity to speak, and thank all of you for coming. To the extent you can, I'd love to see people turn on their cameras because I do like being interactive when I talk to people and give this presentation. And you know, it tends to be much more beneficial for me and for you. Before I get into talking about the two statutes that Gershon mentioned, and that's going to be the primary topic that I'm going to speak about, I just want to tell you a little bit about me. I am a corporate attorney. Schwartz is a business law firm that works with business owners with regard to their business legal needs. My focus is on transactions, both corporate and commercial real estate, as well as various types of contracts. My partner, one partner does primarily commercial litigation and employment law, and the other partner does business succession planning and estate administration. So getting right into the topic of today, the Corporate Transparency Act. I don't know if there's any way for you people to show me how many of you have actually heard about it before you started getting the solicitations for this seminar. But I find that in most cases, people didn't know about it at all. And essentially, the CTA, as I'll refer to it, is a federal law that mandates that certain companies report their beneficial ownership information to an agency called FinCEN, which is the Financial Crimes Enforcement Network. It's a department of the Department of Treasury. It became effective January 1st of 2024, and most companies are going to need to file before the end of the year. So the first question becomes, for a business owner, is my company subject to the law? And there are certain exemptions, but generally speaking, any corporation, whether it's a C Corp or an S Corp or an LLC or a limited partnership, is required to file. Sole proprietors are not included, nor are general partnerships. And it has to do with the fact that the requirement relates to if the entity is formed with the filing of a document with the state, then unless you qualify for an exemption, you're required to file. In addition, foreign companies that have authority to do business in the United States are also required to file. There are 23 exemptions. I'm not going to bore you and go through them all today, but the most common one is something called the large operating company. And this is a company that has at least $5 million of revenue for the prior tax year. And just remember that, prior tax year. More than 20 employees, and has a physical location in the United States. You must have all three requirements in order to qualify for the exemption. And the significance of the revenue for the prior year is that any new entity is not going to qualify for this exemption because they're not going to have $5 million of revenue, even if for the prior year, even if they anticipate doing that in their first year. Another exemption are inactive entities. And there are very specific requirements to qualify for this exemption. The first is they cannot be engaged in any business. There cannot have been any change in ownership. And they cannot have sent or received more than $1,000 in assets during the prior 12-month period. So again, if you meet all of those qualifications, and that's typically an entity that somebody formed but never used, never set up a bank account, never funded it, and is just leaving it there in case they want to use it for some business purpose. Other exemptions that apply are tax-exempt entities, investment companies and investment advisors who are already registered with FinCEN. Certain accountants are not required to file if they have filed with the Department of Treasury in regard to doing Sarbanes-Oxley filings. Insurance companies are not required to file, banks, etc. Now, with regard to what information needs to be provided, essentially the beneficial ownership information report, that's sometimes referred to as the BOI, includes basic information regarding the reporting company and personal information of the beneficial owners. The information about the reporting company includes their legal name. If they do business under a DBA, that would be included. Their physical location, where they were formed, meaning what state, and their taxpayer identification number. That's pretty straightforward. But the next aspect of what needs to be included is who are the beneficial owners of the company, and they need to be included. The beneficial owners are individuals who own or control at least 25% of the ownership of the company, and that's an easy one. Or somebody who exercises substantial control over a reporting company, or ownership interest in a parent company that is a reporting company. And that's where things start to get complicated. There is no limit on the number of individuals who can be identified as beneficial owners. And the more complex the corporate structure, if you have parents and subsidiaries, makes it difficult to determine who needs to be included in the filing.
Question.
Yes.
I thought you said that you need to own 25%. So,
well, that's one aspect of it. Either you're a 25% owner or you have substantial control. You could be a non-owner or an owner with less than 25%, and still be a beneficial owner for purposes of the filing.
Got it. Thank
So
Another
essentially,
question.
go ahead.
What about a company that has as its majority or as the largest shareholders are another LLC?
Then
So
you have to look at the ownership structure of the parent company, and it's going to be the substantial owners and beneficial owners of the parent company who are going to be included for the filing for the subsidiary. Again, that's where it starts getting complicated, because you may have people who have substantial control of that entity who are also non-owners that also need to be included. So there could be an infinite number of people included on the beneficial ownership report, although obviously under the basic requirement of 25%, then you would think there would be no more than 4. But
right.
that's not, hopefully that answered your question.
Okay.
Okay. So again, typically the ownership interest is somebody who has an equity ownership interest. But sometimes somebody can have something that qualifies as ownership, but it's not an equity interest. There could be voting rights, profit rights, options that they can exercise, or any other rights under contracts that mimic ownership. But generally speaking, for most people, determining who has ownership is pretty straightforward. But who has substantial control is a very open-ended qualification. The CTA has specified that included as people with substantial control is anybody who is a senior officer, individuals with authority to appoint or remove certain officers or directors, or individuals who are important decision makers in the area of finance and hiring and hiring and firing of employees, or this is the catch-all, or any individuals that have any other form of substantial control. So this is typically where clients get caught up if they actually understand what they're doing, if they're going to file themselves as to who has substantial control. And the example I typically give is the family company where the parents have the ownership interests, but in reality, it's the kids who are running the business. And in that case, both the parents and the kids are going to have to be included in the beneficial ownership report. There are a few exemptions with regard to inclusion in the report. Minor children are not includable. But quite frankly, if there's a minor child who is an owner of a company, the business owner has bigger problems and is getting no guidance with respect to corporate ownership, because that should never happen. Someone who's a nominee or an intermediary and also a beneficiary under a will would not be includable. But in some cases, well, actually in all cases, if a trustee or a trust owns an ownership interest in a company that has more than 25%, then the trustee is going to be includable, because essentially they're going to be considered to be the beneficial owner. Now, for each person who's determined to be a beneficial owner, again, the information is pretty straightforward with regard to what's going to be provided. It's going to be their name, their date of birth, their residence address, not a P.O. box, and then a driver's license or passport. Now, that gets a little bit tricky because most people are not exactly on top of getting their driver's license changed when they move. Or for various reasons, they have one address on their license, but they actually live in another address. So we've run into issues with clients who indicate to us one address and have the driver's license reflect something else. And we've had to work around that issue, including telling them they need to update their driver's license. The good news is, although originally speculated, social security numbers are not required to be provided for each beneficial owner. Now, some people have lots of companies of which they are beneficial owners. Some people have lots of owners or people who qualify as substantial beneficiaries. or beneficial owners, I should say, you can get what's called a FinCEN ID. And the FinCEN ID actually makes things a little bit easier with regard to filing, because the individual only has to put their information in once, and they get essentially the equivalent of a social security number that they can give to each entity in which they have a beneficial ownership interest. In addition, if any of the information changes and the person goes in and updates their information under their FinCEN ID number, it will automatically update the information for each of the companies that they've been included as part of the beneficial ownership report.
So would an individual go and get this? So if you have a person who owns 25% of company A, company D, and company F, do you instruct that person to go in and file for this FinCEN ID, or do you file for them on their behalf?
Well, this is a filing that can be done by individuals on their own, or they can hire an attorney, an accountant, or just a service company to do it. We do offer that service. It does get a little bit complicated because during the process, there's an email that's sent to the person who is getting the FinCEN ID number, and they have to then put in a code, or we have to put a code for them. So generally, when we do this for clients, we actually have them on the phone while we're doing it, in front of a computer or with access to their email, so that they're able to assist us with regard to getting the number for them.
Okay.
So once it's determined that you need to file, and then you determine, so I believe someone just posted a question. Let me see if I can figure out how to get to it.
I'll read it.
Okay.
What if the name of the stockholder doesn't exactly match the idea? For example, hyphenated or married last names.
Well, if it's hyphenated, that may not be a problem. We haven't come across that issue yet. But generally speaking, it should match what the ID says. So I would suggest in that case, the person should get their ID updated to match whatever information it is that we're going to be providing. And if that's not their legal name pursuant to their driver's license and or passport, then there's going to be an inconsistency. But like I said, we haven't crossed that. I don't know that would get rejected. But the best course of action is to have it match. Now let's talk about the timeline for filing these reports. Any company that was formed or registered to do business prior to January 1st of this year is required to submit their filing before the end of this year. Companies that were formed this year are required to submit their reports within 90 days of filing or formation of the entity. Companies that are formed in 2025 and going forward under current rules are required to file within 30 days. This is a one-time filing unless information that has been reported has changed. In such case, the company would have to update their information to reflect any changed information, and the same time frames apply. It's 90 days this year, and next year it's going to be 30 days. Now, some people have said to me, this seems stupid. I don't really want to do it. What are the consequences if you don't? Well, the consequences can be pretty steep. The statute says that a willful violation of the statute can carry a civil penalty up to, now it's because it gets adjusted by inflation, $591 a day, up to almost $12,000. In addition, there can be criminal penalties, which includes up to 2 years of imprisonment. So how active FinCEN is going to be in going after people who don't file, I can't predict. I would imagine that if there's a substantial effort in trying to file, even if it's incorrect, they're probably not going to hit them with these fines. There's probably going to be, I don't want to call it a grace period because that has not been announced, but certainly I can't imagine that early next year there's going to be a significant push to hold violators responsible and impose these fines. But at some point, these fines are going to start being imposed, and it's a lot less expensive, even if you hire somebody to do this, than to be in violation of the statute. We are cautioning people to be aware of scams. There are companies out there trying to get your personal information by posing as someone who's going to provide this service. So only work with people you know and trust or have been recommended by somebody you know and trust.
Like Lee,
for those,
for example.
Exactly. For those of you on this webinar that are advisors, get the word out to your clients. There's still a lot of people who either don't know about it or kind of heard a little bit about something about it, but don't know the details and certainly don't know the consequences of non-compliance. And certainly this is something that can make you look good in front of your clients. We are offering the service to file for our clients as well as other people who need assistance. We have two ways of doing that. We have somewhat of an automated website where clients will input their information. We will review it, get back to them with any questions, and then we will take care of filing. That's a little bit less expensive than the alternative, which is hiring our firm to do it. We are currently doing it for the cost of $400 for the first entity and $350 for each additional entity, assuming that there is not complex ownership issues that require us to review shareholder agreements or trust agreements and things of that nature. But I suspect that as we get further towards the end of the year and we get crushed with more inquiries to do this work, the price is likely to go up. I hear people are charging anywhere from $200 to $1,000. So charges do vary with regard to providing the service. That's all I have with regard to the Corporate Transparency Act. Before I move on to the Freelance Isn't Free Act, does anybody else have any questions?
Is your website filing option open on your web? Is it on your website where somebody can access it? Or
It is not. It is not on my
methodology there.
Thank you for asking. It's not on my law firm website. We actually have a separate company. It's called Secure CTA Filing, and it's at securectafiling.com.
And anyone who needs that information or any details on this, reach out to Brittany or us, and we can get whatever you need from Lee.
Yes, and we do have a flyer, which I think I've given to you guys, that has that information on it as well.
Hey, Lee.
Yes.
Yeah, you mentioned sole proprietors might be exempt. I'm an S Corp, sole proprietor.
No, you're one or the other.
Okay, got it. So I'm an S Corp, got it.
If you're an S Corp, you're a sole shareholder, you're not a sole proprietor. Sole proprietor is somebody who doesn't set up an entity. So your company would be required to file.
Got it. Thank you.
You're welcome. And, often people have related companies, even if they have one company that has an exemption. And the example I give is automobile dealers. Most automobile dealers have revenue well in excess of $5 million based on the nature of the products they're selling. However, they seem to have other related companies or affiliates that don't have $5 million worth of revenues. It could be something that owns real estate. It could be something that's like a warranty company, or something else that they use in conjunction with their main business. So if you do speak to clients, you want to find out about all of their entities, even if it's clear that their primary entity falls within the large company exemption. Okay, so if there's no more questions about the CTA, I'm going to move on to the New York State law, which is the Freelance Isn't Free Act.
Lee, can I just ask a quick question about the beneficial owner situation?
Sure.
Is someone who has signatory over a bank account, can they be construed as being a beneficial owner?
Yes,
Even
they
though they don't
can.
have the ownership interest percentage?
Yes.
And anybody who signs off on a a sales tax return, a payroll tax return, they could be considered BOs?
They can.
How about a CPA who's
A s-
working with a client on this stuff?
Well, a CPA, if you know, just doing their taxes and signing their tax return is not going to qualify them as a beneficial owner. But certainly somebody who's a CFO and is more involved with the operations of the business certainly could be considered to be having substantial control and therefore part of the filing.
Interesting. So we might have to sign up or get listed on our clients.
Yes, and in that case, I would recommend getting a FinCEN ID number so you can just give them that as opposed to all your personal information and a copy of your driver's license.
Now, who gets the fine? Let's say
The fine is
someone's
the company. It's a fine against the company, not the individuals. Oh, and I do also want to point out with regard to filing, if the entity was formed after January 1st of this year, in addition to the beneficial ownership information, you also have to include the name of the applicant. And the applicant is the person who actually set up the corporation. And you can have up to 2 applicants. So it's either the service company, the attorney, or the accountant who set up the company that's going to have to be included as part of the filing. So
and the
for anybody,
second is the owner.
I'm sorry, say that again.
You said that there's up to 2 applicants. So one is the service provider and one's the entity itself.
No. So there can be up to 2 applicants because in a law office scenario where they're setting up the company, you have me who is giving instruction to my paralegal to set up the company. So both of us would be considered the applicant. But if it's just me and I'm doing it myself and I'm not involving anybody else in my office, it would just be me.
And if it was you setting something up for yourself, then you as the CEO or the CFO or whoever you were in that entity, you would be the applicant.
I would be the applicant and I would be a beneficial owner. So for accountants, or if you guys as CFOs set up companies for your clients, you would be the applicant.
Now, how about just thinking of us? We have some clients where we're more heavily involved. We have other clients where we're operating more as an advisor. We are a CFO that they work with, not necessarily their CFO, as much as we're their advisor. Would that be something where we'd be?
Well, it's fact sensitive,
listed?
but I would say in that case, most likely you would not be included. But
Okay.
it depends on your role and the extent of your participation in the management of the business. Okay, so let me move on to the Freelance Isn't Free Act. This is a New York State law that provides legal protections for freelancers and independent contractors and imposes new requirements on businesses that engage them. It was enacted in 2023 and went into effect in August of this year. It's actually similar to a New York City law that has been in place since 2017. So the first question is, who does it apply to? And essentially it applies to any natural person or entity composed of one person who is paid at least $800 for their services as an independent contractor during a 120-day period. So, the one-off where they're paid less than $800, you don't need to be concerned about this. But if you're going to be spending more than $800 during a 3-month period, then they're going to fall within the statute and you're going to have a written agreement. There are certain exclusions. I'm not sure why, but the exclusions are lawyers, sales representatives, licensed medical professionals, and construction contractors. So to the extent that somebody is acting as an advisor, as a CFO, as an IT person, or whatever other marketing person, those types of things, and they're an individual providing those services, or they have a single member LLC, or they're the sole shareholder of their corporation, they're going to qualify for the protections under this statute. So if they qualify, what's required? A written agreement. And there are certain requirements of what's to be included in that written agreement. It's the names and addresses of the parties, the itemized services that are, and value, and that's the important part, value of the services that are going to be provided, the rate and method and date of payment, which again is important terms, because that's essentially what they're intending to do, is make sure that these people are paid, and a deadline for the provision of these services. These contracts also have to be signed by both parties. And once prepared, you're required to give a copy to the independent contractor, and they must be retained by the company for 6 years. The most important part of this statute is the requirement that the freelancers be paid on a timely basis in accordance with the terms of the agreement, which can be no more than 30 days after the services are completed. Now, as business owners, you may be thinking, this sounds, ridiculous. I'm not concerned. Well, let me tell you what the penalties are for noncompliance. It can be reported. Go ahead.
Can I ask a question about one of the things you just mentioned?
Sure.
There are industries where net 60-day terms is normal, or 90 or whatever. Maybe it's those ones that you mentioned earlier, like construction and medical, who are cut out anyway. But there's all sorts of industries where there's all sorts of norms. This is basically saying you're not allowed to pay people according to industry standards.
Well, it's now changing what the industry standards are going to be.
Okay.
Wow.
Yeah. So, as I started to say, if there's non-compliance, this can be reported to the Department of Labor, and they will do an investigation. Violations can lead to both civil or criminal penalties, and New York State can impose a fine of up to $25,000 per violation. So this is serious stuff. In addition, there's a private right of action, so that if you do not pay the freelancer in accordance with the statute and or the agreement, they can bring an action, and they're entitled to collect double damages and attorney's fees. And unfortunately, when there's attorney's fees involved, it makes it much harder to settle a claim. So this could be a very expensive mistake if a business does not comply with the statute. And in conclusion, the CTA is a new statute of which many people are not even aware of yet. Compliance is essential in order to avoid the significant monetary penalties. It's not complicated, it just needs to be done. And the Freelance Isn't Free Act, again, is also a statute that really must be complied with. There is a form of independent contractor agreement on the Department of Labor's website. It's not a very good agreement. It tries to apply to too much. I was having trouble, going through it and trying to decide if I should give it to clients, because there was too much to be filled out that didn't apply. So I caution people in relying upon that. A very simple agreement could be put together and used for each independent contractor to the extent that they're utilized in yours or your clients' businesses. And one last thing I do want to plug is something that went into effect about 5 or 6 years ago, is the requirement to have sexual harassment prevention training on an annual basis. It's something that's very important because as attorneys who practice in this area, we see situations where there is harassment and it costs tens of thousands of dollars to defend. And most of the time when these cases are brought, the actions are questionable enough that there's going to be a settlement at some point in time. And again, it's a question of how far into the litigation you have to go in order to get the sides to reach agreement. So I strongly recommend in-person training or online webinar training like this, as opposed to just going on a website and telling your employees to just, you know, go through this and click on buttons, because nobody's paying attention. And really what you want to do is prevent the person who's a good person from doing something stupid that gets them in trouble, because the bad person is going to do it anyway. It's that valued employee that you don't want to lose because he does something stupid, says something stupid, and makes somebody uncomfortable. So any questions anyone might have, now would be a good time. Okay.
All right. We're going to put up a quick poll. If anyone wants to get in touch with Lee or with our team, let us know. We'll help make those intros. Please just try to answer this. This will be helpful for us to know what to include you in the future. And thank you again, Lee, for joining us. And anyone, if you've got questions, now's the time. But Lee, I learned a lot. So
Well,
thank
I'm
you very
glad. Thank
much.
you again. I apparently have to fill this out too in order to get it off my screen.
Oh, could be.
And
But so it's interesting, Lee. I was at something yesterday. It was a Jewish legal thing talking about like the Jewish employment law and like how, like from the Talmud, 2,000-year-old employment law, and what's called paying and what's called the period, like similar stuff to this. I was thinking of telling them that, plugging this webinar there. But anyway, one of the topics of conversation there was what is called the end of a period. So if you hire someone for a day, then the period ends at the end of the day. You hire someone for a year, do you have 30 days from the end of the year to pay them? I assume not. But you had mentioned that you have 30 days. So I guess my question is, from when?
well, it's from completion. So
Okay.
I would say in your example, it's the end of the day that they perform the services.
What if they're completing? We had a client recently, they hired us to do a 3-month project. Took 3 months. The services were done after 3 months.
Well, again, the statute says that it can't be more than 30 days. So there's going to need to be interim payments. I believe, actually, I actually retract that. Let me see if I have it here. 30 days after the, but so no, that may be the case where it's not until, if it takes 3 months, once it's completed in the 3 months, I believe it's 30 days after that.
Mm-hmm.
This doesn't have the frequency of pay requirement that certain employment laws have that people are entitled to. I don't know if anybody saw that article. Probably it goes back now about 3 or 4 months, where the women owned a Dairy Queen, and they got hit with $400,000 worth of judgments on the basis that they were paying their employees every 2 weeks when they were considered to be I can't remember what the terminology was, but essentially laborers who were required to be paid weekly because they perform manual labor. So apparently serving an ice cream cone is manual labor. It's intended for construction workers, but apparently it's broad enough to include people who serve food.
Got it. Okay. Someone just mentioned to me that you have to put in an answer on number 1. So we'll address that for the next poll. You can still put in 1 and we won't contact you. That's fine. But thank you for reaching out. We'll just make sure we get none of the above in next time.
I think there was another question. Is landscaping and design considered construction for freelancers? Isn't Free Act? I don't know that off the top of my head, but I don't believe so. but I'm not certain that that's something I'd have to actually look into.
Now, what happens if you hire a freelancer and they're supposed to invoice you and they don't invoice you for more than 30 days? Will you be in violation?
Again, maybe, but probably not, especially if your agreement requires them to invoice you. But the agreement is supposed to provide what the payment terms are. So I don't know that an invoice is a condition to payment. I think that as long as the agreement is clear enough with respect to payment, it's going to be the obligation of the company that hired the freelancer to make payment in accordance with the agreement, regardless of whether or not an invoice is issued.
But plenty of freelancers are hired to do things on an hourly basis.
True.
Right? Your marketing person, you're paying them for
True.
5 hours a week.
That's true.
Or 10 hours or 0 hours, depending. Like we just hired someone, they're doing certain marketing things for us and they invoice. They're supposed to invoice every week, but if they don't, then
as I said, the statute is fairly new. There's not a lot of interpretation of it yet. Certainly to be on the safe side, I would try and certainly show an effort to get that invoice if you have no basis of how to pay them. And if you do have a basis of how to pay them, then pay them even without the invoice. But again, I would certainly want to document the efforts that were made to pay in compliance with the terms of the agreement. And if they haven't complied, then certainly the defense would be it's on them.
interesting. Any further questions? You can type questions into the chat or ask them out loud.
Okay. Well, it looks like we've answered all the questions, although, again, I'm sure things will come up with people. We're here to answer them if you need assistance, and certainly we're here to help with the preparation of an appropriate agreement.
All right.
Thank you, Lee.
Thank you, Lee.
You're welcome.
Thank you.
Have a great day, everyone.
Okay, bye now.
Have a great day. Thank you.